Hi everyone, welcome back. You're watching Markets at Noon. As promised, let's bring on board the management of Magma Fincorp to talk about the Q1 numbers. Interestingly, in a COVID-hit quarter, the profit after tax for the company has surged 3.5 times at 38 crores versus 11 crore rupees. Though, mind you, NII is down at 255 crore rupees. But it's really been the fact that the provisions have fallen from 121 crores to 91 crores and also lower operating expenses. That both of these factors have essentially aided Magma Fincorp's Q1 profits. So let's bring on board Mr. Sanjay Chamria, the VC and MD of Magma Fincorp. Mr. Chamria, thank you for joining us today on ET Now. So to start with, I want to talk to you about your provision number because, frankly, we've seen that NID growth come by and whatever surge in profits we've seen has largely been on account of lower provisions and operating expenses. So how do you see provisioning for the upcoming quarters? And what led to this, the dip in provisions in the quarter gone by?
So usually, you see the provision has come down in this quarter on account of three different reasons. One is that the overall portfolio has not grown. So if the portfolio grows, then you need to make a provision as per Ind AS, even on the standard assets which are sitting in the 0 to 90, which you call as a SMA stage 1 and stage 2. So while they are not NPAs, but you need to make a provision. So obviously the disbursals not being there in the first quarter, the overall portfolio has shrunk. The second is that because of the moratorium being provided and a standstill being provided by RBI, the roll forward to the NPA buckets have not been there, and that is the second reason as to why the provisions are lower. So these two are the reasons more from a market forces point of view, and which has resulted in a lower provisioning by every single player in the industry. Now there are two other reasons as to why it is lower, and that is more internal to us. So in our case, if you see, our overall NPAs have also fallen from 811 crores to 738 crores. And this has happened because of two things. One, a lot of customers who were given a moratorium in the NPA bucket on the new installments, they also paid back some installments, and accordingly, they came down. And second is almost about 60 crores worth of NPAs we wrote off in the quarter because of our policy wherein in SME business, if the portfolio goes into 450 plus, or in the vehicle financing it goes into 730 plus, then we do a write-off rather than making a provisioning of 30, 40 or 50%. And as a result of that, our total NPA shrunk. Third, in fact, we have made an additional provisioning of 32 crores in the first quarter on account of COVID. As you know, in Q4, we made a provision of 117 crores, of which about 8-9 crores was utilized. And now the total additional provisioning under COVID that we are sitting on is about 148 crores. So all in all, we have actually buffered up because we know post-August, when the moratorium expires, then there will be a movement of contracts into NPA. And therefore, we needed to build the buffers and surplus, and that is what we have done. Having said that, despite all those things, our provisioning has been lower in this quarter compared to the last quarter, because last quarter the additional COVID provisioning everyone made was very high, and we also made about 117 crores.
Okay, so I'll take that point forward, what you mentioned, that, post-August, we are obviously going to see perhaps some stress that will be visible because the moratorium ends. So speaking on that itself, I see that the moratorium book has come down on a month-on-month basis. So, what sort of improvements in collections have you witnessed? You mentioned that, one of the reasons why your provisions as well was lower because you had certain collections that kicked in. And what sort of concerns are we seeing on the NPA front once once the moratorium period is over? Could we see some stress over there?
Certainly be an stress once the moratorium period ends, because nobody will reach a zero moratorium cases at the end of August. And while having said that, there has been an improvement. So in June, we brought down the moratorium cases from 73% in May to 45% in June. And July also, while it has not been as good as we expected, as you know, because certain states there was an intermittent lockdown due to the spread of COVID. Despite that, it did better than June, and our overall moratorium percentage has come down to 40% in July compared to 45% in June. And second is the number of customers who had availed the moratorium and who were already overdue between 1 to 3 installments and sitting in the 1 to 90 bucket. They were actually considered more risky because one, they already had overdue before the start of the COVID, and two, they availed the moratorium and then they did not pay any installments which were overdue on which there was no moratorium. So those customers were worth about 900 crores, that portfolio, as on 30th of June. In the month of July, it has come down by 200 crores to 700 crores. And so therefore, we expect that if the same rate continues, then possibly in the month of August, we can bring it below 500 crores, which on our total book of about 16,000 crores will be roughly about 3%. So I rather feel that Q3 will be the real test of not only Magma, but every other bank or NBFC in the sector in terms of the real NPAs, because in 1 month, all the contracts will not go to 90 plus. The 1 to 30 will go to 31 to 60, 31 to 60 will go to 61 to 90. And 61 to 90 buckets have actually reduced a lot because the customers have paid and they've gone to the lower bucket, as I gave the example. And therefore, I think in December quarter is where you will see the real impact. So therefore, we decided as a prudent policy that both in Q1 and in Q2, depending upon the profits that we make, we will keep on making more and more provision so that we build sufficient buffers such that when in third quarter we see a surge in the NPA, we are well protected.
About fresh loans, what is the sense that you're getting in terms of fresh loans? What are your stringent norms that you're taking to assess the impact of COVID on any of existing customers or new customers that come to you?
We actually conducted a survey over 3 lakh customers twice. First, we did it in April till beginning of May, which was the onset of the lockdown. And the second one we did was beginning of July, and which just ended end of July. And contacting 3 lakh customers across 400 districts in the country is not easy. And therein we found that in the truck and the construction equipment, where only 6% customers had deployment in April, May, that number improved to about 55 to 60%. But still, 40% customers did not have deployment even as recent as July end. Second, even the 55 to 60% customers who had deployment, the load availability was about 60%. And therefore, they said that they would rather like to have a reduced installment liability from now until maybe December. And they expect that, with the beginning of the winter season and COVID stabilizing from January onwards, they can be in a better position. So even the RBI guidelines on the one-time restructuring, which has been extended and allowed even for these customers, I think it will be helpful to a great extent. And we will also look at every single customer and their cash flows and deployment and provide this to them. Coming to the fresh demand, what we are seeing that the fresh demand is there in the tractor loans, affordable housing, and in the SME business to an extent. But in the construction equipment and trucks, the fresh demand is virtually, very, very less. And even we are very stringent because we feel when the deployment itself is less than 50-60%, it doesn't make sense right now to take fresh exposures. So what we are doing as a policy in terms of fresh exposure is, one, we are giving support to our existing customers to whom we have given the loan under the ECLG program, wherever the customers are covered under the ECLG program. Otherwise, we are giving it under the CGS guarantee scheme, such that we have additional guarantee from the government or government-nominated institutions to take exposure.
Right, sir. Right, sir. So really short on time. Otherwise, we would have taken this conversation earlier. Always